Have you ever wondered where the smart money really comes from? You know, the kind of cash that fuels those unicorn startups, builds massive factories, and swoops in to save companies from the brink of collapse. Well, it's a world of super high stakes and even higher returns, and today we're cracking open their playbook.
I mean, seriously, what if you knew the exact strategies that private equity and venture capital investors use to find, grow, and sell businesses for absolutely massive returns? That's precisely what we're going to break down right now.
All right, first things first. Before we dive into the how, we really got to understand the who. We're talking about two major players in the investment world, venture capital and private equity.
Okay, so this slide lays it out perfectly. Think of venture capital, or VC, as, well, they're the ones betting on a tiny sapling. They get in on the ground floor with startups. It's insanely high risk, but the payoff can be explosive. Private equity, or PE, they come in when the tree is already grown, but maybe it's sick or needs some expert pruning to grow even bigger. They work with established companies that need help.
So, now that we know who these folks are, how on earth do they find their targets? This is where the real fun begins. See, it's not just about finding an investment, it's about finding the one. It's like searching for a single needle in a gigantic haystack.
The whole thing kicks off with a step they call origination. This is basically how they filled their pipeline with deals. Sometimes companies come knocking on their door, but you know what? The best investors, they're out there actively hunting for those hidden gems.
And let me tell you, this initial pipeline is enormous. A typical firm might start out by looking at a pool of around 100 different investment proposals. Just think about that. 100 different companies, 100 different dreams. But from there, oh boy, the filtering process is absolutely ruthless. That first look is brutal. Right off the bat, they toss out about 90 of them. Gone. They're looking for a very, very specific fit. And most just don't make the cut. That leaves only 10 serious contenders in the ring.
And from those 10 promising companies, the really deep dive begins. We're talking weeks, maybe even months, of intense investigation and hardcore valuation. And in the end, only one makes it through. 100 proposals become one investment. That is the level of selectivity we are talking about. It's incredible. So, they found their 1 in 100 company. How do they make sure it's a home run? Well, it's not just about picking the right horse. It's about structuring the entire deal for success from the get-go. So, welcome to the investor's playbook. Now, for those super high-risk startups, VCs use this really cool tool called the venture capital method. And here's the crazy part. It's totally backwards from how you'd normally value a business. Instead of figuring out what their return might be, the VC decides what their return must be. They say, look, we need a 40% annual return on this thing, period. That's their starting point. Then they work backwards from a future sale price to figure out exactly how much of the company they need to own today to hit that target. The return isn't the result, it's the input. But you know, the real genius isn't just in the number crunching, it's in the terms of the deal itself. Smart investors build in these clever mechanisms that protect their money. And, maybe even more importantly, keep the entrepreneurs laser-focused on hitting their goals. One of their key tools is something called staging. So instead of just handing over a giant bag of cash all at once, they break the investment into smaller pieces, or tranches. The company only gets the next chunk of money when it hits specific, pre-agreed milestones. It's kind of like unlocking the next level in a video game. It keeps everyone on track and seriously lowers the risk.
Another really powerful tool? Stock options. Basically, these give the founders the right to buy more shares later, but at a price that's locked in today. So if they work their tails off and make the company way more valuable, they get to buy those shares for a bargain. It's brilliant because it makes sure everyone is rowing in the exact same direction, towards one goal, making that company worth a fortune.
And this really gets to the heart of it, especially in those turnaround situations. It's all about mindset. It's about being able to look at a field of struggling businesses and have the vision, the guts, to spot the one or two that actually have a shot. It's really about seeing massive potential where everybody else just sees failure.
Okay, so you've found the company, you've structured the perfect deal, and you've helped it grow. But you know what? None of that matters without the final, and I mean the most important phase of this whole process, the grand exit.
And let's be crystal clear about this. The exit is everything. An investor can pour years of their life, their expertise, and their money into a company, but if they can't sell their stake at the end of the day, there is no profit, no capital gain. The whole thing was for nothing. Every single move we've talked about, from sifting through those first 100 companies to cleverly structuring the deal with staging and stock options, it's all pointing to this one moment. The singular goal is to eventually sell that equity for a huge profit. Everything is designed with the exit in mind from day one.
Now this slide right here, it shatters a huge myth. We all hear about the glamorous IPO, right? The big Wall Street debut, ringing the bell. Well, that's the dream. The reality? IPOs make up a measly 1% of exits. The vast majority of the time, it's either a trade sale, selling the company to a bigger one, or a buyback, where the founders actually buy the investor's stake back.
Okay, we have covered a ton of ground here. Finding the deal, structuring it, planning the exit. So let's boil all this down into 3 simple, super powerful rules right from the Smart Money Playbook.
Here they are. Rule number 1, be ridiculously selective. True game changers are rare, so never forget that 100-to-1 funnel. Rule 2, align everybody's incentives. Use smart tools like staging and stock options so everyone is pulling for the same outcome. And finally, rule number 3, always plan your exit from day one. A great investment is only great if you have a clear path to cashing out.
So there you have it, the core strategies of the world's most sophisticated investors. The playbook is officially open. The only question left is, what's your next move?